Recording. Okay, chapter 2 in AOC talks about the development of cryptocurrencies. Thought it seems important to talk a little bit about what traditional fiat money is. And this is just a cartoon, but the fundamentals, I believe, are kind of the core of what it is that you think of as money at the moment. So I think properly, most people think of money as just this real thing, and it has a set of truths about it, but sort of how is it created? So basically, what is money? So what is, maybe being specific, what is a US dollar, right? How does that get created, and like how did your tuition get paid for the time you're here at the university? For example, all right. So it's sort of an odd thing. It's just a bank creates money. And they do that by issuing a loan. And so the loan, so to the bank, the loan is an asset. So like a good thing. And then to the borrower, to the borrower, the loan is a liability. Which in some sense is a bad thing. I mean, if you say it's a bad thing, why does anybody get a loan if they're a liability? Because the loan then hopefully allows the borrower the ability to do something with that loan, right? And what can you do with that loan? So you can now trade that note with other entities, right? So, so for example, trade the loan for a house, right? Or an education, right? So the bank issues a loan, the borrower accepts that loan, and now can use the value of that loan for something that apparently is important enough for them to accept the liability, right? Trade loan for say a house, and then of course plus somehow pay off the liability. So I guess maybe to point out, there's no Fed, there's no anything in this other than trust that the bank issues loans to trustworthy enough borrowers that they can reliably get the loans paid back off in the same kind of notes that the bank just issued. So it is very much a house of cards, and there is something called a reserve that banks are supposed to have. A reserve is a certain fraction of the value that they have as assets that they have to keep as sort of actual money, whatever that really means. And it's usually a quite small percentage of the total loans that they have. And that reserve is to let the borrowers be able to come in and actually get cash money in order to accomplish certain things like buying, coffee. But most of the actual exchanges happen in terms of these notes. of promises. And so in fact, none of those actually require any reserve. So if everybody's trading sort of promises to each other that turn into promises from one bank to another, then there's really very little reserve that's needed in order to support that piece of infrastructure. And so what money is trust in banks that the assets they have are valued in a way that they can trust each other. Banks can borrow money, and so they can do the same scheme, and they certainly do with each other and with the Fed. So like the big bank in the US is the Fed, but there's also other quite big banks that exist in the system, and they can borrow money from each other in order to, keep make more complicated sorts of investment strategies. And so I think the next thing to talk about in this kind of background piece of information is the financial crisis of 2008. That I'll say from a raw numbers point of view, the 2008 financial crisis is actually smaller than the one that we are currently experiencing. But the response to that was really the setting for the beginning of Bitcoin, that there was a proper audience that was looking for an alternative. So let me try to draw this picture a little larger. So money is created by banks in terms of these loans, which then turn into ledger items that are assets and liabilities. And then just by correctly accounting for that between different banks, then that's the monetary system that we have. And how much loan and borrowing has to do with trusting the banks that the loans that they've written are to borrowers that can make good on their payments. So I guess an important part of this then is a very big player in this are these large banks. And yes, there's these individuals, maybe with houses and cars in mind, but I guess in this background picture, it's really houses that they'd like to have. And so what you might think that what a bank would do is directly borrow allow one of these entities, a person, get enough money to just buy a house, for example. And there's a titling agency, there's banks that issue those initially, but actually quite quickly what happens is these loans for different houses and therefore different payers, right? The actual, it's not the house, it's the person who's paying for the house that the loan is to. They're bundled fairly randomly so that they're not in this, like you wouldn't want to bundle all the same houses in, say, Denver, because of hailstorms, you might damage a whole bunch of the same homes at the same time. So you don't want that sort of correlation. And so you try to collect home mortgages randomly spread across the United States. So it's quite unlikely that they all, say, burn down or get flooded at the same time. And so you bundle these together and create an investment, which is called a mortgage-backed security. Let me make room for that word. Probably between the banks. So together, there's something called a mortgage backed security. And the securities is really a collection of mortgages issued to usually quite normal, just people out there that are making payments on their houses. The interest on those payments is really the value of this security. And okay, so there's a next layer. So the banks, you think that, well, okay, then they trade these things. Well, no, you can even make more money than that if you're a big bank by borrowing from another bank, say, or the Fed or something. Instead of borrowing enough money to buy one of these, right? You borrow enough money so the banks make their own loan. And then they use that loan for a short amount of time, say 24 hours. and they use that to buy multiple mortgage-backed securities. So the loan over the course of 24 hours lets them own a vast number of mortgage-backed securities. And then for the course of that one day, they collect the interest from all of those mortgage-backed securities. And at the end of the day, they sell that security off to some other bank. And so they can take this, it's called a leveraged position. So they leverage a loan so that instead of just making money off the money they have enough money just to make the payments for 24 hours on a much bigger loan, take that loan, buy a bunch of these, hold them for a day, which will make enough money to pay off the payments they need to make, plus, when things work well, a lot more money, and then they sell the whole asset off to somebody else, another bank. And so it's a fairly complicated scheme. And by the way, I guess I pointed out it's similar to what these people are playing. If the values of houses are going up, right, then you start seeing these TV shows for flipping houses. And the idea is if this house is you're confident the house's value is just increasing over time, then it makes sense to, instead of buying a house that you can directly afford, to get a loan for the biggest house you could possibly afford, right? Because in that case, the more you own, if you can just keep it for say a year and then sell it at a higher price because the value's gone up, then you'll make so much more money out of the increase in value that it'll make up for whatever interest you're paying the bank. And so in this world of everybody on this side being very happy with this investment strategy of mortgage-backed securities, what the banks really wanted in this picture was more mortgages so that they could trade mortgage-backed securities with each other and make a ton of money. And so back before 2008, what was going on is it was becoming easier and easier to get loans because the banks really wanted mortgages to do this stuff with in the background, to the point that the loans were being issued to people that really couldn't pay. And so the crisis really came down to like far more people than the analysts were deciding, because it was really people trying to just make money and issuing loans were doing, but far more than what was expected of banks of these loans were going default because they were being issued to people that just couldn't afford the size of the loans that they were being allowed to own. And so, and all these people were banking on the idea that the house values would increase enough that they could make their payments and then they'd make money off the whole scheme. But back here, there was a second layer of failure where these mortgage-backed securities, these were the records of value that the banks were issuing to each other about how many assets, remember the assets and liability part. So assets and liabilities that they were recording for themselves had to do with marking down, well, this is how valuable like this asset is. And it wasn't just one of these, right? They were making loans to each other to get very large numbers of these, own the group of them for a short time, and then try to sell that off to somebody else. Well, the whole thing suddenly stopped because they quickly realized that the assets were incorrectly valued because of the number of defaults. And so you couldn't just sell this to the next bank because the next bank didn't want it, right? The value of this was much lower than the value that you bought it for. And you didn't actually buy it, right? You, as a bank, made a loan to buy a bunch of these. And then the bank that issued the loan to you assumed that you're going to be able to pay it back. But now you can't, because the thing you were going to sell to the next bank, they don't want that. And so you don't have any assets to give that bank in order to fulfill the much, much bigger loan, right, than these things that you had made a promise to some other bank. And these loans were being issued to each other, and the value of those loans were also, if you remember, the bank side of things, loans are assets. So a vast number of assets were really these loans to each other to support these mortgage-backed securities, all of whose value was made suspicious. It was it's called a derivative product, right? So these people were trying to leverage a derivative. The mortgage-backed securities were derivatives on that. The loans on the mortgage-backed securities were derivatives on that. And suddenly the bank's tally sheet of assets, they didn't trust anymore, not with each other. And so there was a real possibility that the banks were just going to close. They just didn't know how to issue money anymore because they couldn't trust any assets or liabilities from each other. And so that was the crisis that sparked the 2008 recession, and was the environment where the creators of Bitcoin and that sort of group of people had to suggest a different tool. And so that was the part of the money story that I'd like to make sure you had seen. All right. Thank you very much.